going to keep looking here at Chapter 15 related questions. Here's one that used to be a lot more fun to work because there's actually something to work through at one point. Now it's a lot easier to answer, not a good answer necessarily. So it says Mr. Wang's corporate employer transferred him from its Seattle office to its San Jose office. Mr. Wang incurred $18,000 of moving expenses to relocate his household to San Jose. And it asks us, which of the following statements is true? So at one point, you'd have to do some kind of calculation about how long it was from his old house to his workplace in Seattle compared to what the distance between his old house to his new location. And if that was over, I think, 50 miles, you could take some moving expenses. But now, no moving expenses are allowed currently. So how much moving expenses would be zero. The thing, though, is which of these situations kind of add to that. And that's A. So if his employer paid him $18,000 moving allowance, right, you can't deduct your moving expenses. So what happens to that? It gets included in gross income. So that's a form of compensation you can think of. Okay, so now we're going to switch gears a little bit because we talked a little bit about retirement contributions and things of that nature. But now we're going to talk about the other side of it, about when you get money out. So in number 16 here it says Louise, age 51, quit her job and received a $70,000 distribution from her employer-sponsored qualified retirement plan. She immediately contributed $50,000 to a rollover IRA and used the remaining $20,000 to purchase a car. Compute the tax cost and premature withdrawal penalty, if applicable, of the distribution if Louise has a 32% marginal tax rate on ordinary income. Okay, so of the total of the $70,000, that $50,000 that was the rollover, that really means, she put it from one account to the next. So no tax on that. And there, you want to make sure, I think you do it within 60 days or something of that nature. But we're assuming she met those guidelines. However, the $20,000 that was kept out, it is going to be potential that she's going to have to, she's definitely going to have the income tax. Right, so she's going to have to pay income tax on it, which is ordinary rates. And the question is she going to have an early withdrawal penalty? Right, so in this case, we're assuming, because it doesn't say anything, I guess, that I should mention it, we're assuming she's not using it for COVID-related purposes, because remember, that was one of the exceptions. But since she's not using the $20,000 for a qualified exception, she has to pay regular income tax and the early penalty on it. Right, so that $20,000, the regular tax part, take the $20,000 multiplied by 32%, and that should be $6,400. But then you also need to add $20,000. She has that early withdrawal penalty, which is 10%. So 20,000 times 10% is going to be $2,000. So that's a total tax of $8,400. So the answer to this one is B. Right, so, but let's just put it together to see how harmful is that really to her. Right, so we're saying she paid $8,400 out of the $20,000 it was based off of. Right, so for that early distribution, she's really paying a 42% tax rate. That's a lot. So that's why you don't want to use your early distributions and think it's not going to come into play if it's not something that's an acceptable exclusion. Okay, so now Mr. Thainer, age 47, withdrew $22,000 from his employer-sponsored qualified retirement plan to pay for his daughter's wedding. Very nice of him. Compute the tax costs and premature withdrawal penalty of the withdrawal if Mr. Thaino has a 37% marginal tax rate on ordinary income. Right, so I'm going to let you work that. I will tell you That's not an exception. It does not qualify for an exception to be a daughter's wedding. So here I'll just give you a moment to hit pause and work through very similar to what we did before, and then I'll come back and let you know the answer. Okay, so the answer is going to be C, $10,340. 18 says, this year Mr. Cox elected to contribute $4,000 of his $95,000 salary to his Section 401k. So now we're looking a little bit back at contributions again. Mr. Cox's employer made that $4,000 matching contribution. So how much compensation is reported on Mr. Cox's W-2 form? Right, so what we're looking at is his gross wages, $95,000, gets adjusted by that $4,000 of the elective contribution that he made. But that's the only side of it, right? The employer side is going to be a deduction for them. But he is looking at, because we don't know, we have not been told it's a Roth 401k, so we're assuming it's a traditional plan. So traditional plan, you get your adjustment up front when you make the money payment, and then later on you're going to be taxed on the distributions. So he's going to have $91,000 reported on his W-2, at least in a certain box. Number 19 says, well, in 2018, Amanda earned $70,000 self-employment income. She was allowed a $4,945 above-the-line deduction for her self-employment tax. Compute Amanda's maximum contribution to her profit-sharing Q plan. And that could easily have just said 2021. That's not changed. Right, so that's when we looked at that one slide and said for Q plans for self-employed people, you start with your self-employed income. You need to adjust it, though, by the amount of above-the-line deduction, because that's what I said. They're not going to let you make a contribution based on something you were already getting a deduction amount. So this part, they're going to make you back out. Right, so if we take the $70,000, subtract $49.45, that's going to be $65,055. Now we take that and we multiply it by 20%, because that was the limit that they could contribute to. So we take the $65,055 multiplied by 20%, and we come up with $13,011. So the contribution maximum she can make is $13,011. Okay, number 20 says, which of the following statements comparing traditional, so to make sure I covered it, that's why I put this on here, to Roth IRAs is false? So we're not looking for a true statement, we're looking for a false statement. A says, for a 57-year-old individual, the maximum allowable contribution to either type of IRA is $6,500, right? That might actually need to be $7,000, I can't remember. It's one of the two, but that should be a true statement. B says contributions to traditional IRAs may be deductible. Contributions to Roth IRAs are non-deductible. No, that's true. That's the difference. Your contributions to traditional are deductible. Contributions to IRA are not. C says individuals who have reached age 70 and a half must begin liquidating either type of IRA. And that's the false statement, because you must liquidate the traditional, not the Roth. You'll be limited from putting more money into the Roth, but you don't have to take money out. So that's the answer there, the one that's truly false. You might have to adjust that number. I'll look to make sure. But the one I wanted you to get there was the fact that you don't have to start taking money out of the Roth. The last one there, just to make sure we covered, individuals may have to pay a premature withdrawal penalty from either type of IRA. Yeah, even if you have a Roth IRA, but you start taking it out early, you have to pay that penalty part. So that is a true statement.